So today we will be covering five important topics of finance, which are short selling regulations, fair value accounting, bank runs, bank regulation, and earnings manipulation. Welcome to Vibrant Publishers podcast, where we bring you engaging interviews with distinguished experts across diverse fields. Today, we are joined by Xu Jiang, who is a professor at Fuqua faculty. He received Excellence in Reviewing Award from Journal of Accounting Research for the year 2021. He's also the recipient of 2016 Master of Management Studies Excellence in Teaching Award. Professor Jiang, thank you for joining us today.
It is my pleasure. Thank you for having me.
So today we will be covering five important topics of finance, which are short selling regulations, fair value accounting, bank runs, bank regulation, and earnings manipulation. I would like to start with short selling regulation. And if you could explain to the audience what exactly it is and how does it work in the stock market?
Yeah, sure. Short selling is the opposite to what people usually do in the stock market, which is buying stock. When you're buying stock, you purchase the stock and hope the future price of the stock is going to appreciate. When you're doing short selling, you're doing the opposite. So you're borrowing shares from somebody else and sell it, and hopefully the stock price is going to decrease in the future, and so you can buy back at a cheaper price and earn profits.
Right, correct. And so why do regulators implement rules around short selling and how does it impact the investors?
Well, short sellers usually are the first party to blame when it comes to crisis period, because short sellers, they only profit from stock price decrease. So usually there are some accusations that because they want stock price to decrease, they could sometimes spread rumors or just create panic to reduce the stock price. And because most people don't want to see stock price decrease, so they they're averse to short sellers, and so regulators, they're also concerned about short selling would decrease price, create panic, and so they would implement rules a lot of times to limit short selling, in particular during crisis period. Its impact on investors: if there are restrictions on short selling, then usually the short selling activity is restricted, and so it could have like two effects on investor. First is the stock price may not drop as much as if short selling has no restrictions, but at the same time, to the extent that short sellers, they may have information about like bad news about regarding if the firm is not doing good, then banning short selling may reduce the speeds with which such bad news gets transmitted in the market. So that may affect the overall efficiency of markets, and eventually it may hurt investors.
Right, correct. Now, moving to the second topic, which is fair value accounting, can you explain that in simple terms and how it differs from other accounting methods?
Yeah, sure. In simple terms, fair value accounting means that you want to record the assets and sometimes liabilities on your balance sheet using the most recent, the most accurate value that you can find. Sometimes it's the direct market value, and sometimes you may need to use some valuation methods to determine the value. It differs from one of the most common accounting methods, which is what we call historical cost accounting. So use an example to explain. Suppose you buy a stock, and the cost that you incur in purchasing those stock is the historical cost. And fair value accounting just means that, let's say, at year end, when you need to prepare your financial statements, you record the value of the stock at its most recent market price, not as your purchase price.
Got it. Now, what happens during a bank run, and why do people suddenly withdraw their money? And how do regulators try to prevent and manage these bank runs?
Oh yeah, sure. So um, bank run is essentially a phenomenon of people's lost confidence in banks. So during the bank run, a lot of times people think that the bank may not survive. And when the bank may not survive, then if your deposits are not insured, then there is a good chance that you may not be able to get your deposit from the bank. So in this case, the best strategy for you is to go to the bank to withdraw your deposits, and hopefully before everybody else and before the bank runs out of resources. And so a lot of times people withdraw their money is because they think that the bank is not doing good. They think that others are going to withdraw money. And so if they don't withdraw money, then the bank will not have enough money left for them. So for regulators, what they try to do, there are two ways to try to prevent the effects of bank run. The first is through ex ante monitoring the bank's risk management practices, make sure that the bank's foundation is sound, so people would not think that the bank is bad, and so they would like to run on the bank. Um, and so if exposed, a bank is really running into trouble, and people starts withdrawing their money. So usually what regulators do is, as what we see in last year's Silicon Valley Bank event, so they would ensure the depositors that their deposits are safe. They could just say everybody's deposit is safe. So in this sense, if your deposits are safe, the government's ensure that you're going to get paid in full. Then in that case, you would not be panicked, and so you would not choose to withdraw your deposit.
Right. And that takes us to the next topic, which is bank regulations.
No
So,
problem.
what are some of the common regulations that they must adhere to? And how do these protect both banks and the customers?
So this bank regulation is related to what we talked about before, the ex ante procedure
Right.
to prevent bank runs. So banks need to be regulated because they're subject to runs, and so if people run on the banks have to shut down, and so banks cannot provide financing to the general economy, and it will bring the general economy down. And so because of this, very important financial intermediary role that banks play, so that's why it's important to regulate banks. So the common regulations they must adhere to usually is really related to several ratios. Um, for example, the leverage ratio, the capital ratio, etc. All of these ratios they make sure that the bank has enough capital to buffer bad news. So essentially, it means that the bank has to invest in sufficiently significant amount of safe assets so that if the bank runs into trouble, so if depositors want their money back, then the bank has enough uh, safe and liquid assets to liquidate and to pay back the depositors, therefore reducing the panic of the depositors. So those regulations, if they're enforced well, then it will make sure that the bank would always have enough resources to pay back their depositors. So if depositors they know that the banks have enough asset to pay them off, they would not rush to withdraw from the banks, and so the bank run problems would be alleviated or even prevented. So in this sense, the banks are safe; gets protected, and the customers they're also safe because their deposits are safe in the banks.
Okay, thank you for sharing that. Now, our last topic is earnings manipulation. What does it mean and why do companies engage in it?
Yeah, so earnings manipulation basically means that companies they use whatever tools they can to boost their earnings. Um, some of the tools are within the discretion allowed by the accounting rules, but some of them are, kind of outright fraud. The companies, they would like to do that because usually, companies, they're run by managers, and their compensation incentives focus a lot on short-term performance. So they want to make sure that in the short term, they can meet the market's expectations of their performance. Otherwise, they will get a hit on their compensation. So they would try to manipulate earnings to make sure in the short term they look good, even though in the long term it may not be good. But over the long term they may not necessarily be in the company, or they put more weight on their short term compensation versus their long term compensation. So that's why they engage in it.
Got it. And how can the investors and public detect the signs of these earning manipulations in the financial statements?
The there are various ways to detecting earnings manipulation. One of the most common method, and this has been established in the academic literature, is so usually market is going to form an expectation. Let's say your next quarter's earnings is going to be how much. If you if your reported earnings just meet the expectations or beat the expectations by very little, let's say 1 cent per share, then this would be an indication that there might be some earnings manipulation going on. Another way is to detect if the firms, they cut their expense by a lot to meet their earnings targets. Because earnings is revenue minus expense, so you can manipulate earnings either by overstating your revenues or reducing your expenses. If your expense is much lower relative to the comparable period, let's say last year, then that could also be a red flag.
Got it. Now, all the topics that we talked about today, how do they contribute to the overall stability of financial markets?
Short selling regulation regulates short selling, and as we talked before, short selling could have its benefits, and it could have its costs. The benefit is that if there are people who truly have bad news about the firm, about the manager is working on some shady deals, or doing some manipulation, letting short sellers convey this information will be good for them, for the overall market. But short sellers can also can also spill rumors. So it's unjustified rumors that try to bring down the company and benefit them by themselves. So those are the bad things, and that would destabilize the financial markets. So the regulation needs to consider this trade-off. Fair value accounting, and bank regulation. Fair value accounting, that's particularly important for banks, because banks, they have lots of their assets that are subject to fair value. So in terms of accounting, we want to make sure that the assets and liabilities, they're measured to our best estimate of their economic value. But at the same time, fair value may contain noises. For example, if the price that fair value matches into comes from fire sales, marking the fair value could actually have destabilizing effects, because then you will have more fire sales, and which drives fair value down more. And so fair value accounting, we need to think about very carefully in terms of how to measure the fair value for contributing the overall stability of banks, which would affect the stability of real economy and just the financial markets. And so is the bank regulation. You want a proper regulation to make sure that the banks are sound, and to minimize the probability of bank runs and banking crisis, and that would also contribute to the overall stability of financial markets.
Correct. Now, what do you foresee as the potential future trends in financial regulation and accounting practices?
So in terms of fair value standards, which is and bank regulations as well. So this is really a, the fair value really applies a lot to the banking sector. The issue about those is, all these accounting rule changes or regulations, they're trying to fight the last crisis, and they're not trying to foresee the current crisis. I'm sorry, to foresee the future prices. So because we have the Silicon Valley Bank, we have all these regional banks that have issues last year, and that's really because of their this unrealized losses in their marketable securities. So because those regulations, they would try to fight the last crisis. So I would think about the all these fair value standards and bank regulation. They're going to be to focus more on banks' ability to be able to hold these assets to maturity, even though even though they're not supposed to sell the asset in the middle. If they have to, then they will have this issue. So the regulation will probably focus on what's the ratio of your insured deposits versus uninsured deposits, because that would determine whether or not you need to sell those assets despite they have unrealized losses. And so for those banks with a lot of uninsured deposits, they may apply more strictly the fair value accounting standard and more stringent bank regulation. For short selling regulations, because there isn't really much of a crisis going on. Regional bank crisis doesn't really affect the stock market much, so I do not foresee any change in short selling regulations.
Right. Thank you for sharing that, and
Sure,
thank you, Professor Jiang, to take out time today to join us and sharing your valuable insights.
my pleasure, and it's great to be here.
Thank you. And to our audience, thank you for tuning in, and we hope you found this podcast informative and insightful. Once again, Professor Jiang, thank you.
You're very welcome.